Good morning. Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We've been coming to you live as we do each quarter for quadruple witching options expiration from the Nasdaq FLX options trading floor. Joining me for this segment is Sean Clark. He's the Chief Investment Officer over at Clark Capital Management. Sean, I can't believe it, but we're talking about your second half outlook. I mean,
it's hard to believe this year is flying by, isn't it?
It really has flown by, and there's been no shortage of news, that's for sure. But let's get into it. What are your expectations for the U.S. markets and the economy? Because data's looking pretty good right now.
Yeah, great. You spot on, right? Data's coming in really strong. It looks like second quarter print so far is going to probably come in 4-handle-ish on real GDP. Leading indicators are out to a new high. Yield curve is flattening but not inverted yet. Jobless claims are at 30-plus years lows. From an economic standpoint, things seem to be accelerating. As hard to believe as that is, the economy seems to be doing well and accelerating. What that means for the market is, well, right now we've got the Russell 2000 at new highs, Nasdaq Composite at new highs, AD line out to a new high, credit spreads low, behaved. It looks like risk on, so we would expect maybe a little bit more volatility as we get into the second half of the year, especially in front of the midterm elections. But our expectations are the market hits new highs.
It's really interesting because even with the trade war rhetoric and what you're saying with interest rates moving higher, which the market has not reacted to well in the past, it seems to be digesting this news really well. And it's almost like, are there so much headlines out there and there's so much rhetoric out there that it's being ignored at this point?
Well, I think a couple of things. One is I think the market will usually react in a negative way to what it doesn't know. All of that's already known. We've had geopolitical risks before. We have them again. We have tariffs. We have them again. Our impression of all of that is it's just noise. Fundamentally, the economy is strong and the market's really responding to the fundamentals of corporate America and the economy. If we look out over the next 12 months, forward earnings estimates are out to new highs. From a PE standpoint, we have a forward PE on the S&P 500 that's trading almost right where it was post-Brexit. So from a valuation standpoint, it looks like the market probably
which is indicative of the major averages continuing to hit new highs. Do you think we're going to kind of end 2018 the way 2017 ended?
I would be surprised if it did from a volatility standpoint, right? So all of 2017, VIX averaged about 11. We're a 12 handle right now, down significantly from the 50 handle that it was trading at in early February. Volatility's come in, but it's still a little bit elevated from last year. As we approach the midterm elections, I would expect to see the market have some sort of a correction, in addition to volatility elevated a little bit more than it is, but we would use any volatility in a market correction as a buying opportunity for higher prices into 2019.
Let's talk about the impact of the FOMC rate decision. We all knew that the hike was going to come.
Yeah,
and
it was broadcast.
Right. I mean, it was broadcast and telegraphed, and I think that's why the markets digested that well. Now it seems as if the wild card, which was the fourth rate hike, seems to be on the table because the presser was relatively hawkish.
Right now, yeah. So Fed's going to hike 2 more times this year, probably 3 times next year. And 2020, if you can look that far out, they say 1 more. That's 6 more hikes. So we've seen the yield curve flatten, not invert. 2/10s, that spread right now is about 35 basis points. That's the lowest it's been since post-crisis in 2007. Same on the 90-day T-bill yield to the 10-year. That's just now under 100. It's about 97 basis points. Flattening. We expect to see more flattening as the Fed continues to hike rates. We would look for the curve to invert probably sometime in the second half of 2019. For us, that'll tell us, all right, let's start the clock now.
Right.
Then when it inverts, look for a recession to happen 12 to 24 months post-inversion.
So what are you recommending to investors at this point? Staying fully vested?
Staying invested.
Right.
The market's moving higher. As we said earlier, Russell 2000 at new highs. Risk on is moving higher. Enjoy the trend while it lasts.
Right. So until you get to that point in 2019 where you see that inversion, that's when you're going to perhaps change tack.
But even with an inversion, historically speaking, going back and looking at every recession back into the 1950s, the yield curve inverted roughly 12 to 24 months before the recession started. So even when it inverts, we still think there's probably more upside potential for the markets. Whether it's late 2019, early 2020, that's probably when we're going to start to be a little bit more concerned.
All right. Well, thank you very much for joining me on the FLX trading floor, and we'll see you again in Q3.
Great.
Thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.